Look, I need you to think about something for a second. Right now, as you're watching this video, you probably have money sitting in a savings account earning what, maybe 0.5% interest, and you know you should do something with it. You've been telling yourself for months, maybe even years, that you need to figure out investing or finally open that IRA or at least move it to a high-yield savings account. But here's the thing, you haven't done it yet. And every single day that goes by, that indecision is costing you actual money. Real dollars that could be working for you are just evaporating. And the crazy part, you're not lazy, you're not stupid, you're actually being too careful. You're stuck in what I call analysis paralysis, and it's quietly destroying your financial future. My name is Elon Musk, and I spend way too much time thinking about the psychological traps that keep smart people poor. If you're someone who researches everything to death, who has 17 browser tabs open about index funds but still hasn't actually invested a single dollar, or who keeps waiting for the perfect moment to make financial decisions, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because today we're going to calculate exactly how much your indecision is costing you, and more importantly, I'm going to show you how to break free from it. Here's what most people don't realize: indecision isn't neutral. It's not like you're just treading water, staying in the same place. You're actively losing ground, and I'm not talking about some vague, abstract loss. I'm talking about money that could have been in your bank account but will never exist because you waited. Let me show you the math, because once you see these numbers, you can't unsee them. Let's say you're 28 years old and you have $10,000 sitting in a regular savings account earning 0.5% interest. You know you should invest it in something like an S&P 500 index fund, which historically returns about 10% annually. But you're not sure if now is the right time. The market seems high. Maybe there'll be a crash soon. You want to do more research. You tell yourself you'll figure it out next month. So you wait 1 year, just 12 months of indecision. In that savings account, your $10,000 grows to $10,050. $50 bucks, congratulations. But if you'd invested it with a 10% return, you'd have $11,000. That's $950 more. Now you might be thinking, okay, $950 isn't life-changing money. And you're right, but here's where it gets really interesting, and this is the part that should genuinely terrify you. That $950 difference isn't just about 1 year. It's about what happens over the next 37 years until you retire at 65. Because that $950 you didn't earn compounds. At 10% annual returns, that single $950 from year one would have grown to $37,000 by the time you retire. You delayed for 1 year, and it cost you $37,000 in retirement money. But wait, it gets worse. Most people don't wait just 1 year. They wait 5 years, 10 years. I've met people who have been planning to start investing for literally 2 decades. If you wait 5 years to invest that $10,000 by retirement, the difference between the savings account and the index fund is over $160,000. $5 years of indecision. $160,000 gone. A 2023 study by Vanguard found that the average American who considers themselves interested in investing waits 7.3 years from when they first think about it to when they actually open a brokerage account. 7.3 years. Let me be blunt, that delay could cost you your entire retirement. So why do we do this? Why do smart, capable people who can make 1,000 decisions every day completely freeze when it comes to money? I've identified 3 psychological traps, and I guarantee you're caught in at least one of them right now. Trap 1, the perfectionism trap. You want to make the optimal choice. You don't just want to invest. You want to invest in exactly the right thing at exactly the right time with exactly the right strategy. So you research and research and research some more. Here's the problem: perfect doesn't exist in investing. There is no perfect moment. There is no perfect stock. There is no perfect strategy that wins every single time. But good enough does exist, and good enough executed today beats perfect executed never. I had a friend, let's call him Mike, who spent 3 years researching whether he should invest in VTSAX or VTI. For those who don't know, these are both total stock market index funds. They're basically identical. The expense ratio differs by 0.01%. That's 1/100%. Mike spent 3 years optimizing for a 0.01% difference while his money sat in a savings account losing to inflation. The cost of that research, over $8,000 in missed gains. He paid $8,000 to figure out a difference worth about $3 per year. That's the perfectionism trap. Trap 2, the comfort zone penalty. Your savings account feels safe. You can see the money, nothing dramatic happens. It just sits there, and that feels responsible and adult. Look, I get it, investing feels scary because the numbers move. You could lose money. And our brains are wired to fear loss more than we value equivalent gains. This is called loss aversion, and it's been documented in hundreds of psychological studies. But here's what most people don't realize. By trying to avoid the possibility of loss, you're guaranteeing a different kind of loss. Inflation is currently running at about 3–4% annually. If your savings account pays 0.5%, you're losing 2.535% of your purchasing power every single year. That $10,000 in your savings account, in 10 years with 3% inflation, it'll be worth about $7,400 in today's dollars. You didn't keep it safe. You watched it shrink by $2,600. The comfort zone isn't comfortable, it's expensive. Trap 3, the information overload illusion. This one's insidious because it feels productive. You're listening to podcasts, reading articles, watching videos like this one. You're learning, surely that counts for something, right? Wrong. There's a concept in behavioral economics called the action bias, the idea that doing something feels better than doing nothing, even when doing nothing might be the right choice. But with financial indecision, we've created the opposite, an education bias. We've convinced ourselves that consuming more information is equivalent to taking action. It's not. A 2022 study from the University of Chicago found that people who spent more than 20 hours researching investment options before opening their first account had virtually identical 10-year returns to people who spent less than 2 hours. The only difference: the people who researched longer started 18 months later on average, which cost them significant compounding gains. More research didn't make them better investors, it just made them slower ones. Now you might be thinking, okay, but these are just examples with $10,000. What about real life where I'm consistently earning money and could be consistently investing? Great question, let's look at that. Imagine two people, Sarah and Tom. Both are 25 years old, both earn $60,000 per year. Both decide they can invest $500 per month. Sarah starts immediately. She opens a brokerage account, sets up automatic monthly investments into a simple 3-fund portfolio, and doesn't overthink it. Tom wants to wait for the right time. He wants to build up a bigger emergency fund first. He wants to pay off his car loan. He wants to understand options trading before he invests. He waits 5 years, then starts investing the same $500 per month. Both invest until age 65. Both get the same 10% average annual return. Sarah, who started at 25, ends up with approximately $3.8 million. Tom, who started at 30, ends up with approximately $2.3 million. Tom invested for 35 years. Sarah invested for 40 years, just 5 more years, but those 5 years cost Tom $1.5 million. $1.5 million. That's the wealth penalty of indecision. And here's the thing that really gets me frustrated. Tom probably made that 5-year delay for good reasons. He was being responsible, he was being careful, he was making sure he had all his ducks in a row. But sometimes being too careful is the riskiest thing you can do. Alright, so how do we fix this? Because I'm not just here to depress you with math. I'm here to help you actually change your behavior. The key is understanding that indecision isn't really about lacking information. It's about lacking a framework for making decisions with incomplete information. Here's the framework I want you to adopt, and I call it the good enough, right now principle. Step 1, set your minimum viable action. What's the smallest financial decision you can make today that moves you forward? You don't need to figure out your entire investment strategy. You need to figure out what you can do in the next 24 hours. Can you open a brokerage account today, even if you don't fund it? That's a minimum viable action. Can you transfer $100, not your whole savings, just $100, into a high-yield savings account? That's a minimum viable action. Can you set up a meeting with your HR department to increase your 401k contribution by just 1%? That's a minimum viable action. Stop trying to solve your entire financial future in one decision. Just take the next smallest step. Step 2, embrace good enough investment choices. Here's a secret that the financial industry doesn't want you to know. For 95% of people, a simple 3-fund portfolio is completely adequate. You don't need to pick individual stocks. You don't need to time the market. You don't need a complex strategy. You need a total stock market index fund like VTSAX or VTI, a total international stock index fund like VTIAX or VXUS, a total bond market index fund like VBTLX or BND. Allocate based on your age and risk tolerance. A common starting point is your age in bonds, the rest in stocks, split 70-30 domestic international. Is this optimal? Maybe not, but it's good enough, and good enough today beats optimal never. Step 3, automate everything. This is non-negotiable. The human brain is terrible at consistently making good decisions. We're emotional, we're forgetful, we're influenced by headlines and market swings. So remove the human element. Set up automatic transfers from your checking account to your investment account. Set up automatic investments into your chosen funds. Make it so that investing happens whether you're feeling confident or scared, whether the market is up or down, whether you're paying attention or not. Vanguard found that investors who use automatic investments have 2.9% higher annual returns on average than those who manually decide when to invest. That difference is almost entirely because they avoid the temptation to wait for a better time. Step 4. Implement the 48-hour rule. Here's a rule that changed my life. If a financial decision is reversible and low risk, I give myself 48 hours to make it. That's it, 2 days. Opening a savings account, 48 hours. Setting up automatic investments, 48 hours. Increasing my 401k contribution, 48 hours. I'm not saying be reckless. I'm saying that most financial decisions don't require weeks or months of deliberation. They require enough information to make an informed choice and then the courage to act. If you can't make a decision in 48 hours, the problem isn't lack of information. The problem is fear. Step 5. Calculate your personal cost of waiting. This is the most powerful exercise you can do. Right now, I want you to actually do this. Take the amount you know you should invest but haven't. Use a compound interest calculator. There are free ones online. Put in your amount. 10% annual return, historical average. Years until retirement. Now run it twice, once as if you invested today, once as if you wait another year. Look at that difference. That's the cost of one more year of indecision. Screenshot it, make it your phone wallpaper. That number should haunt you enough to take action. Now I know what some of you are thinking, and I want to address the most common objections directly. But what if the market crashes right after I invest? It might. Markets go down, that's part of investing. But here's what you need to understand. Historically, the market has crashed on average about once every 8-10 years. It also recovers on average within 2-3 years. And over any 20-year period in the history of the S&P 500, the market has had positive returns. If you're investing for retirement and you're not retiring for 20+ years, short-term crashes are noise. They're irrelevant. And here's the thing people forget. If the market crashes after you invest, guess what? Your automatic monthly investments are now buying stocks at a discount. You're buying low. That's exactly what you want. But I have debt. Shouldn't I pay that off first? It depends on the interest rate. Credit card debt at 22% interest. Yes, absolutely pay that off first. That's a guaranteed 22% return, which beats any investment. A mortgage at 3.5%. No, invest while making your regular mortgage payments. Your investments will likely return more than 3.5%. Student loans at 4.6%. This is a judgment call, but I'd split the difference. Pay the minimums, invest what you can, maybe throw extra at the loans when you get bonuses. The point is, it's not all or nothing. You can make progress on both fronts simultaneously. But I don't have much to invest. Why bother with small amounts? This is probably the most damaging belief out there. Let's say you can only invest $50 per month. That's it, just $50. From age 25 to 65, at 10% returns, that turns into $316,000. $316,000. That's not nothing, that's a retirement. Small amounts matter because time matters, and time is the one resource you can never get back. Here's what I want you to understand. The real barrier to taking action isn't knowledge, it's identity. Right now, you probably see yourself as someone who should invest, someone who plans to invest, someone who wants to invest. You need to become someone who invests, present tense, active identity. That shift happens through action, not through more planning. You don't think your way into being an investor. You act your way into being an investor, and then your thinking catches up. Every day you wait, you're reinforcing an identity as someone who doesn't invest, someone who stays on the sidelines, someone who lets opportunities pass by. Is that who you want to be? I want to tell you about a conversation I had with a colleague a few years ago. She'd been planning to start investing for 8 years. 8 years of research, of reading, of waiting for clarity. Finally, she got fed up with herself and just opened a Vanguard account. She threw $5,000 into a target date retirement fund without really understanding what it was. She was terrified she'd made a mistake. 2 years later, that account is worth almost $7,000. She's been automatically investing $200 per month since then. Her total portfolio is now worth over $11,000. Was her initial choice optimal? Probably not. She could have saved a few basis points on fees with a different fund. She didn't perfectly optimize her asset allocation. But you know what? She's $11,000 richer than she was, and more importantly, she broke the paralysis. She proved to herself that she could take action without perfect information and survive. That's the power of imperfect action. It's not about being perfect, it's about being in motion. Okay, we're coming to the end here, and I want to make sure you actually do something with this information. Because the irony would be if you watched this entire video about the cost of indecision and then decided you'll take action later. So here's what I want you to do in the next 24 hours. Not this week, not when you have more time, in the next 24 hours. If you have no investment accounts, open a brokerage account today. Vanguard, Fidelity, it doesn't matter, pick one and open it. You don't even have to fund it yet, just create the account. If you have an account but aren't using it, transfer $100 into it today and buy one share of a total market index fund. Not $10,000, not your life savings, just $100. Prove to yourself that you can do it. If you're already investing but not consistently, set up automatic monthly transfers and investments today. Pick an amount that's uncomfortable but not impossible. Make it automatic. If you're already doing all of this, increase your investment rate by just 1%. If you're investing 10% of your income, make it 11%. You won't notice the difference in your paycheck, but your future self will notice the difference in your retirement account. The specific action matters less than the fact that you take action. Today, while this video is still fresh in your mind, while you still feel that spark of motivation. Because here's the truth, tomorrow you'll have new reasons to wait. There will always be uncertainty. There will always be one more thing to research. There will always be a reason to delay. The market might crash or it might not. Inflation might spike or it might not. Interest rates might change or they might not. But one thing is certain. Every day you wait is a day you can never get back. Every day you wait costs you money that could have been compounding. Look, I'm not trying to pressure you into something reckless. I'm trying to wake you up to the fact that indecision itself is a decision. It's a decision to accept less wealth, less security, and less freedom in your future. And the crazy part is, taking action is actually easier than staying stuck. Once you break through that initial resistance, once you make that first move, the rest gets so much easier. You don't need to become a financial expert. You don't need to spend years studying. You need to take one small step and then another and then another. Because wealth isn't built by people who make perfect decisions. It's built by people who make good enough decisions consistently over time. Your future self is watching you right now, watching to see if you'll take action or if you'll add today to the pile of days you waited. What's it going to be? If this video helped you, hit that like button and subscribe so you don't miss the next one. Drop a comment and let me know what your first action will be. And if you know someone who's stuck in analysis paralysis, send them this video. It might be the push they need. Now stop watching YouTube and go open that account. I'll see you in the next one.